Somewhere in a data center right now, call it New Jersey, call it Virginia, it doesn't matter, a machine did something this morning that should stop every SpaceX buyer cold. It received an instruction. Not a suggestion, not a recommendation, an instruction. Buy SpaceX. Here's what's strange about that machine. It doesn't know what SpaceX does. It couldn't tell a rocket from a refrigerator. It has never opened the prospectus. It doesn't know the company lost almost $5 billion last year. It has no opinion on whether $1.75 trillion is a fair price or an act of collective insanity. It knows exactly one thing. A rule changed overnight, and that rule says it must own a slice of SPCX. So, it will buy. Today, at whatever number is glowing on the screen when its turn comes. And the part that should put a knot in your stomach is this: that machine is not alone. There are thousands of them. Pension funds, insurance pools, the quiet index funds sitting inside your own 401k. And as of this morning, June 13th, every one of them got the same instruction at the same time. The headlines are calling that a wave of demand, a vote of confidence. Rocket fuel under the stock. I'm going to spend the next few minutes showing you why it's the opposite. Why the most price-blind buyers on planet Earth being forced to buy a stock is not a floor under your investment. It's a trap door. And right now, you are standing on it. Let me be honest about what this video is and what it isn't, because I'm not here to rage about Elon Musk. By almost any measure, SpaceX is an extraordinary company. It launches more rockets than entire nations. Starlink is genuinely rewiring connectivity for millions of people in places the internet forgot. If you came here to be told the rockets won't fly, you are in the wrong place. This isn't about whether SpaceX is a great company. It's about a piece of plumbing underneath this stock that almost no coverage has touched. A rule that quietly went live today. A rule that turns the sheer size of the world's biggest investors against its smallest one. You. And there's a number attached to it that's been flying around all week. $15 trillion. Some accounts are saying 20. Forced to buy SpaceX, they say. Hold on to that number, because in about 4 minutes, I'm going to tell you why it's wrong and why the real number, the much smaller one, is actually the scarier one of the two. By the time we're done, you're going to understand 3 things. What this rule actually is, in plain English, why a stock with almost nothing available to trade is the single most dangerous kind of stock to buy into a forced buying wave. And the one quiet move that lets you watch this entire thing happen from the outside, instead of from underneath it. None of it requires you to predict anything. It just requires you to see the machine before you step into it. So let's build it from the ground up, because everything that follows depends on getting this part right. Start with the thing nobody bothers to explain. When you put money into an index fund, and if you have a retirement account, you almost certainly do, you are not hiring a human being to pick good companies. You're hiring a rule. The rule says, hold every company in this index, in exact proportion to its size. When a new company joins the index, the fund has to go buy it. Not because a manager looked at it and liked it, not because anyone ran the numbers, because the rule says so. That's the entire design of an index fund. It doesn't think, it doesn't judge, it doesn't care about price, it just matches the list. That's why it's cheap, and for most people, most of the time that is genuinely a good thing. It's probably the best financial decision most people in this economy will ever make, but it carries a side effect almost nobody notices. When a giant new company gets added to a major index, thousands of these rule-following funds all have to buy it at the same moment. For a few days, they become the most powerful buyers in the entire market, and the most blind. They will pay any price. They have no choice. There is no setting on the machine labeled that's too expensive. There is only match the list. And the bigger the company, the more of it each fund is forced to buy. SpaceX didn't sneak in at the bottom of the index. It walked in near the very top, one of the largest companies in the world on day one. Which means the required purchase isn't a sliver, it's a slab. Now hold that idea, a tidal wave of buyers who are not allowed to say no, buying a slab of one company, and let me give you the second half of the trap. Because a forced buyer is only dangerous when there's almost nothing for them to buy. Here is the number that makes SpaceX different from almost any IPO in history: the float. The float is the slice of a company's shares that actually trades freely, the shares that regular people can buy and sell on any given day. For a normal large company, that's most of the shares. For SpaceX, it's about 4%. Read that one more time, slowly, 4%. The other 96% is locked up, held by Musk, by employees, by the venture firms that funded this thing for the better part of 2 decades. They are contractually forbidden from selling right now. So the entire ocean of trading in this $2 trillion company is happening on a puddle. 4% of the shares are doing 100% of the trading. Now drop the forced buyers into that puddle. Today, June 13th, the first major index inclusion went live. SpaceX entered the Big Psi Global Indexes barely a day after it started trading on a fast-track rule that didn't even exist a few years ago. The old rule made a new company wait months to qualify. The new one lets a giant in almost immediately. And there is a second switch waiting behind it. A similar fast track can pull SpaceX into the NASDAQ 100 in a matter of weeks, not the full quarter it used to take. 2 machines. The first one fired this morning. The second one is loaded. And the second one has a feature that turns the screw even tighter, a detail almost nobody talks about. When a company joining the NASDAQ 100 has a very low float, under 20%, the index doesn't weight it by the tiny number of shares that actually trade. It inflates that number. For a sliver float company, the index can treat the float as if it were several times larger than it really is. So SpaceX's 4% gets counted as if it were a much bigger chunk, which means the funds are forced to buy even more of an even thinner supply. This is the whole mechanism, a nearly unlimited wall of forced demand, a nearly empty shelf of actual stock, and a rule book that, on the second machine, makes the funds reach for more than the float can possibly provide. When an immovable amount of buying meets an almost non-existent amount of supply. The price does not rise gently. It gets squeezed upward, fast, hard, and for reasons that have nothing to do with whether the company became more valuable overnight. It didn't. The rockets are the same rockets they were on Thursday. Only the plumbing changed. And here's the honest part I promised you. That $15 trillion headline, it's wrong. It takes every dollar of passive money on Earth and pretends all of it is about to pour into this one stock. It isn't. Most of that money tracks indexes SpaceX isn't even in, or holds it in a slice so small it rounds to nothing. The real amount of forced buying is far smaller, realistically tens of billions of dollars across the inclusions. But here's the twist, and this is the exact thing the loud accounts get backwards. The smaller number is worse. Because the danger was never about how big the buying is. It's about how big the buying is relative to what's available to buy. Tens of billions of forced dollars chasing a 4% float is like trying to pour a swimming pool through a garden hose. The pressure has nowhere to go but up, and it goes straight into the price. So the stock climbs. The headlines cheer. Every tick higher feels like confirmation that you were right to get in. And almost none of that climb is the market deciding SpaceX is worth more. It's a rule book with no eyes, shoving money into a stock there isn't enough of. If this sounds like theory, look at what already happened in the first session. The stock priced at $135. It opened at $150. Within the day, it touched $176, 30% above the IPO price, before settling back to around $161. At its peak, the whole company was briefly worth more than $2 trillion. The demand behind it was almost cartoonish. More than $250 billion in orders. The deal oversubscribed several times over, and more than $70 billion of that coming from ordinary retail investors. And here's the human detail that tells you everything about who's on which side of this. Most of those retail buyers asked for shares and got crumbs. One woman put in for 5 shares through her brokerage app and received exactly 1. She flipped it for about $24 and called it a win, and honestly, getting out with a small gain might have been the smartest move in this whole story. Because that intensity, that frenzy to get any slice, is the fuel the squeeze runs on. The forced buying lifts the price lift makes headlines, the headlines pull in the people who didn't get an allocation and now feel like they're missing the rocket. So they chase it on the open market, at the inflated price, convinced the climb is proof. We've watched this shape before. A thin float stock gets force-fed into an index. The run-up detaches from anything resembling reason, pure mechanical demand outrunning supply. Everyone celebrates. And then, once the forced buying is satisfied and the locked shares begin to free up, gravity comes back all at once, because the same machine that had to buy has no rule forcing it to keep buying once the box is ticked. The pressure that lifted the price simply switches off. SpaceX has the steepest version of that setup anyone has ever seen. The tightest float, the fastest inclusions, the largest valuation, the most retail money standing in line. So who is this actually built for? Because a price that gets pushed up by forced buying is a gift to somebody. Not to you, to the people holding that locked up 96%. Look at the timing, because the timing is the whole tell. The forced buying inflates the price now, through the summer and into the fall. And the lockup, the contract keeping insiders from selling, starts lifting in December. So the machine spends roughly 6 months pumping the price up on rules nobody voted for, and right as the stock reaches its most inflated. The doors open for the people who got in early to sell into it. The elevated price isn't a floor protecting the person who bought today, it's a launch ramp for the person getting out. The forced buying builds the exit. And the demand that exit needs, somebody standing there ready to absorb all those freshly unlocked shares, is you. Same stock, same week. 2 completely different deals, depending on which side of the lockup you're standing on. None of this is illegal. None of it is even unusual for a deal this size. It's just engineered. And the people who engineered it did not engineer it for you. So where does that leave you if you genuinely believe in this company? There are 2 loud options, and both of them are losing seats. The first is to chase the squeeze. Buy now, into the forced buying wave, at a price being mechanically inflated by buyers who don't even know what they own. You've just watched, step by step, why that's the weakest position in the entire market. The second is to write SpaceX off forever on principle, which throws out a genuinely remarkable company because the plumbing around its stock was rigged in its first week of life. There's a third path, and it costs you nothing but patience. You let the machine finish. Mark the calendar instead of the ticker. The first index inclusion went live today. The NASDAQ inclusion, if it comes, lands in the next few weeks, and when it does, that's the last big wave of price-blind demand, not the first. The first real earnings report, the first time you'll see audited numbers instead of a story, arrives around November. Worth noting, the company's own president has already said, out loud, that she doesn't want investors focused on quarterly earnings. Sit with that. And then in December, the lockup begins releasing, which is the moment all that held back supply finally meets a market that no longer has any rule forcing it to buy. By the time those 4 things have passed, the price will no longer be set by a blind machine squeezing a 4% puddle. It'll be set by reality, real supply, real demand, real numbers on the record. That's the price worth making a decision on, not the one being manufactured on your screen this week. The market rewards the patient far more reliably than it rewards the early. You did not have to own the great companies of the last decade on day one to do extraordinarily well. You just had to wait for the price to stop lying. So here's what to actually watch, not for trading, but for sanity checking the story as it unfolds. Watch the float. As the lockups lift, that 4% puddle becomes a lake, and the squeeze that lifted the price loses its grip. Watch the inclusions. The day the index buying is done is the day the single largest source of price-blind demand disappears. And what's left is the market's honest opinion. Watch November's earnings. That's the first time the story is forced to become numbers. And watch December when supply and demand finally meet on level ground. 4 signals. Every one of them public. Every one of them sitting on a calendar you can read right now, today, while everyone else is busy reading the ticker. That habit, reading the machine instead of the headline, is the entire thing we build for our members, the wealth logicians. Inside the vault, there's a running breakdown of exactly these mechanics. Float math, index inclusion windows, lockup calendars, applied to whatever deal is next on the board, because there is always a next one. SpaceX kicked the door open, the next round of giants is already lining up right behind it, and they will run this same playbook to the letter. If you want that lens in your corner before the next one lands, that's where it lives. But whether you ever touch the vault or not, take the habit with you. Go back to that machine in the data center. It's still buying right now as you watch this. It will keep buying until its rule is satisfied, and then it will stop, not because the price got too high, but because a box on a checklist got ticked. It feels nothing. It learns nothing. And it will not be there to catch the stock this winter, when the locked shares come flooding in and there's no rule left forcing anyone to buy. The number on your screen today is loud, and it's climbing, and it feels like proof. It isn't proof. It's a machine with no eyes, pouring a swimming pool through a garden hose and calling the overflow a rally. Just make sure you're not the one standing under the spout when somebody finally turns the water off.